Good morning, guys. Happy Friday. Julian Williams here, and welcome back. I get the pleasure of hosting global trading experts Boris and Kathy. Boris, Kathy, how you guys doing today?
Fabulous. We're doing great. We're just trying to keep track of our positions as we're talking right now.
That's right.
Market moving so fast.
So if you're looking off to the screen, I know what you're doing.
Exactly.
No worries. Well, guys, we got obviously a whole lot to cover. So I just want to make sure that we, get over everything. Obviously, we've got a lot of, bank news, a lot of juiciness. So let's go ahead and dive right into it. First Republic Bank. I think this is something that everybody's, that's on their minds. Let's dive into this a little bit.
Yeah, basically, this is an unprecedented bailout by First Republic's peers. And what you're seeing in the markets today is that's not good enough. Stock futures are down a lot. The US dollar continues to fall. And it goes back to what we've been talking about all of last week, Julian, which is that, the investors still do not believe there's just one cockroach in the kitchen. They still worry about their own banks. They still worry about, these are very targeted bailouts for specific banks. What happens if it's another one? Are these banks going to come in with another massive, bank bailout? So I think that when you have a crisis of confidence, it's really, really hard to turn the negative sentiment. And that is what we're seeing. First Republic is getting their bailout, but, it's an underlying issue in the banking sector. And that's why, we're having weakness in stocks today. That's going to, all of this sentiment is going to carry into next week's Fed meeting.
Right. Now today, with the rate being a little bit lower, coming out, I guess, where the prediction was, where we have at 63 and some change. Is this a good thing? Is this, does it not really move the market all too much? Let's talk about that a little bit.
No, I think the rate expectations coming down is a good thing because it's obviously going to be supportive for the market. It means that the Fed is not going to try to keep breaking the system. It was clearly obvious that going at this speed, when you're coming from zero interest rate policy and you're raising rates so fast, you're destroying the bond collateral that banks hold. Banks primarily hold almost all their assets in bond collateral because they're trying to get yield on their bonds. Now, big banks, first of all, have the trading capability and also the balance sheet capability to kind of hedge out the risk. But for those little banks, when you hedge out the risk, you hedge out the profit, right? So they all got greedy. They were like, I don't want to put on the hedges because that means I'm going to lose my carry trade, my role between my deposits and what I'm getting on the bonds. So they were just like, I'm gonna risk it. And as you can see, when they risk it, it creates a really, really terrible situation on the P&L basis. It destroys essentially all of their equity and a lot of their bond holdings. So I think this is a warning sign to the Fed, and especially the market is acting like you better take it seriously. I'm watching the Dow in front of me, like US 30, our favorite little instrument that's hitting lows of the day as you and I are speaking. And that's pretty much, I think, communicating to the Fed, you better put on the brakes, Jerome, or we're going to be in much bigger trouble than you think it is, because everything in the financial system revolves around credit. And if you start squeezing the credit too hard, the whole system seizes up. That's what people don't understand. I hear a lot of people talk about moral hazard, and if you rescue these people now, you're just going to create the problem worse and worse and worse. And what people don't understand is that it doesn't matter. If you kind of give them a punishment that they deserve, the only people that are going to be victims is everybody else in the world, because everybody lives on the air that the banks produce. Everybody lives on the credit. If you think of credit as air, what you're basically saying is punish these guys by taking away air. Well, who's not going to be breathing? You and I and everybody else. So that's the problem.
I really have to add to that. Back in 2008, which is what everyone's talking about, the last bank crisis we had. We remember losing Washington Mutual, Lehman Brothers, and Bear Stearns. But no one really talks about the 300 other banks that we lost between 2008 and 2010. And that's really the problem that people are worried about right now, which is that, yes, you're getting the rescues of specific banks. But, in 2008, that triggered the Great Recession. And we haven't seen this type of panic in the market since 2008, as well as COVID. And both times it triggered recessions, one shallow, one, deeper. Regardless, there's a lot more at stake than what you're seeing right now. And I think that the that investors are tuning into that, and they're not being fooled by these bailouts because they're continuing to hit the sell button.
Right. Well, I mean, that was kind of my next question. Is this a trickle effect, to other banks, and does this really concern other, what does it do to us right now? Of course, they're bailing, folks out left and right. Is this just going to continue to happen? What does it do?
I mean, I think it does. And I think, so you have, first of all, you have banks that I would call concentrated deposit banks. So First Republic is very similar to Silicon Valley Bank in that it's a very exclusive bank. It relied on very rich people having a lot of deposits. I mean, there's a branch literally right outside of my apartment building, and it's like they have their own boardroom. They allow the depositors to essentially like they might as well have a shower and an amenity spa there. It's kind of that kind of a bank. But what that means is that you have very concentrated deposit base. That obviously makes it, and no hedging, right? The concentrated deposit base, no hedging is just a formula for disaster. The big problem, I think, could be when you talk about the next regional banks like PNC, like First Third. You guys are probably familiar with them because they're local to you. Where's their book? Where's their hedge book? Where's their mark to the market? That's what nobody really knows because, banking is a very non-transparent business. I'm sure the Fed is all over those guys right now. I'm sure the regulators are all over there trying to make sure that they have the capital and the conditions. But yeah, that's the big thing. And of course, you want to play, if you want to play doom scenario, I'm happy to give you the full doom scenario. The real big doom scenario is, so there are 4 what we call structurally significant banks in America, which is JP Morgan Chase, Bank of America, Citibank, and Wells Fargo. Like these are basically do not fail, cannot fail banks, right? Of the 4, the one that people who I talk to in the banking business are the most concerned about, which has the most vulnerable balance sheet, is actually Citibank, and that's the real big problem. So like you want to create a doomsday waterfall. It's Silicon Valley Bank, maybe Deutsche Bank in Europe, Citibank. Like that creates, the world financial crisis that you want to. I don't think we're even close remotely to that. I think regulators are much more wary of all those issues, but that's your doomsday scenario if you really want to play it.
Okay. Yeah, that's not going to happen. The Germans are not going to let Deutsche Bank fail at all. Yeah. And the Swiss aren't going to let Credit Suisse fail, although they still could get sold. There's no way the Germans are going to be the ones that make the headlines.
Right. Now, I mean, with the 11 banks coming in, with this whole First Republic Bank deal to kind of bail them out, does this work? Do we feel that this is going to kind of resolve the issues? I know depositors are kind of, or I should just say the credit ratings obviously didn't come out so positive because they're afraid that the depositors are going to take their capital out. What do we think there?
Well, I think it goes back to what we said. I think that the depositors of a lot of regional banks, especially if you have above FDIC, even though they have covered SVB and Signature, they're going to be worried. They're going to be, kind of taking their money out, moving into different types of accounts, maybe creating custodian accounts for their kids that they didn't think about before, creating more joint accounts that can be protected. So there's going to be a lot of money moving in and out of smaller banks. And I don't think that this is the solution. I don't think that this is the end of the crisis that we're having. I think that you're going to see the big banks see more money flow into the big banks, and you're going to see that depositors really pull out. Not just from some of the big name regional banks, but from the tiny Great Neck Bank to the Ridgefield Bank to the ones that are really, really local. They're going to be the ones that could see some more significant exodus.
Right.
So does that mean, Kay, that you're sort of negative risk, or that you don't necessarily you may be negative banks, but you think that ultimately it's not on a macro sense it's not negative risk? How do you
listen? We've made a lot of profits this week selling risk. Even today, I had these beautiful, and I'm going to share my screen to show you this. I'm going to show you my chart. Hold on. Perfect. And it's going to be my dollar yen chart. We had these beautiful zip sell signals. I woke up this morning, I tell Julian, we talked about how I traded the Asia Open and the New York Open. New York Open, I get up, check my charts at 6 a.m. We already had the zip sell signal in dollar yen. At the time, Dow futures were down maybe about 175 points or so. U.S. Treasury yields, which are now down, 10-year yields are now down 5%. They were down about 1.25%. So we had stock futures down. We had, Treasury yields falling. We had the risk off, dollar yen zip sell signal triggering. And so all of that kind of, gave me a very strong conviction to get into a big dollar yen short trade. And, I put it on at 6. Within less than an hour, it went down basically 100 pips. So, this is how you trade, these volatile markets. It's what I said. This is how you turn panic into profits. Yep. You turn panic into profits by basically, making sure that you stick with your strategy and you stick with the trend. And I'm going to take that same approach going into next week. Now, we have FOMC. So right before FOMC, everyone should be flat. But going into FOMC, I think everyone's going to be skeptical about, how much the Fed can help, how much can U.S. regulators help. So to answer your question, Boris, yes, I'm still on that risk-off trade because a crisis of confidence is really tough to fix. It's really tough to change that tide of negative sentiment.
Nice. I like the turn panic into profits. I think we need to trademark that. Very, very cool.
That's the title of my YouTube video this week.
Still keeping the same ideology as far as, half of the stop loss risk is normal, because we have obviously these uneasy kind of volatile markets.
Although I got to tell you,
just to clarify, Julian, we said half of the position, not half of the stop loss risk.
Yeah, exactly. And larger, actually, double the loss.
Right.
Yes.
Yeah. Right. We know what you meant. We know what you meant.
Yeah.
So if I could share my screen now, because if we're gonna have a battle of indicators, you show me yours, I'll show you mine. But let me share screen. Which one do I want to do? I want to do this one, US 30. Okay. So and again, I know it's a big screen here. You guys are is it coming up? This guess is taken. There it is. So, but look at look at all the bright greens are just take profits. So yes, my indicator also was able to really pick up a lot of this P&L. We were just scalping all morning long in our live session today, just making money on the US 30, and similarly on the Nasdaq. Picking up P&L here. Now, what I think is actually even more interesting is that when we're looking at kind of like bigger trades, let me just change this to, sorry, cancel. I want to change it to to our, sorry. Oh, inputs. I'm in the wrong place. Okay, I want to change it to swing base. What's going on over here? Oh, no, I'm locked. Sorry.
All right. So while Boris is fiddling with his charts, I want to say that in addition to my indicator, I actually posted the trade live on Twitter at KathyLeanFX, my handle. So, it was available for everyone to see. Boris and I don't hide behind past profits. We're real traders, real timestamp trades. It's out there. And so even if you were on Twitter, you've seen, how I felt and why I felt it, and the trade that I liked the most to kick off the day.
Yeah. So I'm just zooming out. By the way, yes. Not only does Kathy post her trades, and not only do I post all my trades literally the second they happen algorithmically in our Discord room, and in my MT5 account is completely transparent. In other words, you can log into my MT5 account and see all the positions in the account, which is really, really great. As a matter of fact, I'm showing people in our MT5 account exactly how you build to the 10% profit gain, using my bounce strategy. So those people who are, watching us, who are part of Surge, this is part of your free subscription. Come join us. I will literally show you how we build to the 10% P&L over about a month and a half, given the way Surge's structure works and how how our trades work. So and because all of our trades are algorithmic and they're completely repeatable, everybody gets the exact same trade. It makes it a lot easier. But yeah, you see, like on a swing basis, which is really where I want to operate these days, because the shortest scalp time frame is just so volatile. You can see how many P&Ls there are here. There's 3 or 4 P&Ls just on swing, and if you hit the US 30, there was this is such a look how wide the volatility is today. I have to shrink the chart, but you see boom, 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 all over the place. There are hits like all especially yesterday. There's all sorts of hits here that you could have picked up, and every one of those hits just adds to your P&L and helps you towards that 10% target in Surge, which is what we try to aim for in our live trading. Okay, so I'm done with my indicator. You can go back to your charts. Your charts are a little prettier. Mine are just more.
I need to zoom in.
I know. I'm zooming out because like look at how wide the range is today. It's just such a huge range that I had to zoom everything out. But yeah, I mean the thing is
bouncing off the 31,800. Do we think obviously US 30? Now you maybe
yeah.
Looking at the S&P as well.
Yeah, no, I mean this. So what do we have? We have the initial puke panic, right? Friday. Then we also have quadruple witching hour, right? So options, stocks, futures on options, futures on futures and options, derivatives on derivatives, dogs and cats living together. It's like, that old Ghostbuster line from Bill Murray. Everything is, is happening today. And we have 0 days to expiry options. So this is something up in case people are not familiar with it. Very, very popular strategy in the US market now. People buy same day expiry options because they move huge, because they have no time premium. They literally move like, with huge volatility. And people like it because it's a fixed risk, right? You buy an option, if it moves, great. If it doesn't move, it's just the cost of the option. Some people like to do the opposite, like to sell those things. That's the exact opposite risk profile, where risk is unlimited, but your gain is limited. So whatever floats your fancy, but it's become such a popular strategy in the U.S. markets that it actually now is greater than the whole volume of equities in the U.S. market. So I think you're going to see, as I said I tweeted out today, the close is going to be lit, meaning I think the close is going to have very volatile. It wouldn't surprise me at all if we have like kind of a down day. As you said, we held the bottom right now. If we kind of bounce around, they're going to just swing it right back up all the way through the midpoint, and then just squeeze us for like 200 points in a matter of minutes. So if you're a short this market, I absolutely tell you to walk on eggshells. It's completely possible that all of these forces can combine for just a vicious vertical squeeze. Bear markets have the best rallies because that's what makes bear markets so hard. Bear markets it'd be easy if bear markets went down. They don't go down. They fall down and then they rally back up, kill you, and then they fall down again. So you got to be very, very swift. I mean, one of the things that Kathy does really well is she'll hit it, take the profits, go to the sidelines. That's what you got to do in bear markets.
Yeah, that's right. Well, I was going to ask you on that note. Did you feel like and this is obviously a question for the viewers as well, did the ECB thing, affect US 30? I almost felt like it was at the same time that news was released, that huge rally yesterday. I know I had gotten, bitten a little bit on that, but luckily, obviously, a good stop loss and whatnot, I was able to kind of move on to the next trade. But ultimately, either that, or is it now in hindsight, the 11 banks, the 30 billion being pumped into, was it that what was making the market soar up?
The ECB story, and I'll let Kate chime in on this in a second, but the ECB story, and in the back of my mind, it's like one of the, don't you ever hate it, like when you have like in the back of your mind, you go, I wonder if this is going to happen. And then you go, I should have traded this, right? Yeah. My thought was yesterday, Kay, was she's sounding pretty hawkish. Like she's really not giving too much of an inch. And that's really the German DAX has been really, really rallying strong. And she's basically just pouring water on that fire. And I was like, I think the German DAX is going to be really vulnerable. Had I I only did one trade in DAX. Had I look at the DAX today, 1, 2, 3, 4, 5 winning trades today, all the way to the downside. DAX was just talk about a falling knife. That is a beautiful falling knife today. I just didn't quite connect the dots as well as I should have on that. But yeah, what do you think on the ECB story?
Well, I mean, yesterday's movement in the ECB is basically what central bankers, would love to see. If everyone did as well and as properly and as right as they did, it would be the best case scenario. And what I mean by that is how they made a big rate decision, raised interest rates 50 basis points. Everyone was watching this meeting. It was the hottest event of the week. And yet, what happened? Euro barely budged after the rate decision. The markets barely responded. This is like the ideal situation for central banks, which is a absolutely no response, low volatility market after a big rate decision. And so, in many ways, they did it right. But the reason why they did not see a move in the euro is because they basically kept the market guessing, right? They did 50 basis points, and they didn't really provide any guidance whatsoever. So the market has no clue, how they feel. Now, as Boris said, it is a tinge of hawkishness because even today we heard from a bunch of ECB officials, and they basically said more needs to be done. But we haven't seen much movement in the euro. I sold euro yen because ultimately, I still think it's a risk off environment. I think that the markets, weren't impressed at the time with the ECB because otherwise euro would be a 107 and not, basically where we talked, where it was when we started talking at the beginning of the week. It hasn't moved at all. So we sold euro yen, and euro yen's down a lot today. And it's all about being selective. It's about putting yourself into the right trades, especially when, you can't figure out what is happening. You can't really figure out what the central bank is saying. All you need to do is, stay focused on what is the bigger story in the market, which is still the bank crisis. And like you said, the 11 banks bailing out First Republic was big news. It kind of offset some of the ECB stuff yesterday. But, at the end of the day, it's about how many cockroaches are in the kitchen, and that's what everyone's still worried about.
Right. So you would agree that. Oh, go ahead. I'm sorry, Boris.
Sorry, I was going to say there's two other stories that I haven't really paid attention to that are really important today, which is really shocking to me. First of all, oil is 66, which is unbelievable, 3% down on the day. That's obviously a reflection of recession fears and global contraction, and also I think some credit issues, because obviously oil is very credit sensitive. It's the most financed financed commodity in the world, so there could be some credit issues as well going on through there, which I think nobody would have, if I said to you oil 66, nobody would have guessed that into the summer driving season, into coming up. I mean, it's good for the consumers, so that'll be positive. But then the other story, which I think is really interesting, is kind of under the radar, is gold. Just 1959. I mean, that's up. What is that? 2%? I haven't even paid attention. But gold is going to hit. If gold hits 2,000, a lot of people are going to perk up their ears. It's going to be really interesting to see. Bitcoin also, by the way, participating really well at 26,000. So it's kind of what you're seeing. It's finally all of those things that people have talked about, which is gold, Bitcoin acting as risk-off assets, people diversifying into crypto as a diversifier, which I think is a fool's errand, but that's a completely separate story. That seems to be working finally. Like people are finally starting to say, "Oh, you know what? I don't want my savings in a bank. I want them in crypto."
Yeah, that's really dangerous because crypto tends to perform well when the markets are flush with liquidity. And when you have financial market conditions tightening, that actually is, a very poor environment for crypto. Because you think about it, if you're a regular American and you're seeing your retirement accounts, you're seeing your investment accounts start to evaporate, are you really going to diversify into something you really don't understand? Or is there a greater chance that you're going to go to cash? And I think, you're seeing Bitcoin rally, but I don't think it's a fool's game.
You don't think it's long term?
Yeah.
I got you. Yeah. So, I mean, I think, Kathy, you kind of chimed in on it that, the question I guess everybody has is, should, day traders be concerned, about the news and that kind of stuff? But like you said, I think there's still opportunity here, right? It's kind of a risk off, there's blood in the water, so to speak, but you can jump into something like this as long as you're obviously very careful with how you're going about it.
Well, I mean, the great thing about being day traders is that, we're not married to a direction. And so, we can go long, we can go short. We let the markets tell us where it's going, and we use our strategies to guide us into the trades. So, is something going on over there for us?
US 30 went down 200 points.
This is completely with the windows closed. It's just fire. It's just fire. Don't worry. It's just fire.
So of course,
Yeah.
as usual,
So
assess, don't guess type deal, as usual.
yeah, I mean, being a trader is, amazing because we can go long and short. And so, I'm flat for the day. We had made our money, we, got our trades, and next week, we'll start new and see where the opportunities are. I don't think you have to be afraid. I think this is the terrible environment for investors. It's the perfect environment for traders.
I like that.
Yeah. As a matter of fact, I just closed out my short. We're at the lows on the 30, and we just hit the lows on Nasdaq. I closed them both out, so done for the day. 137. We are 3,000 to our $10,000 target. So again, come hang out with us. I'll show you what we do every single day in terms of trying to make that $10,000 target. $10,000 target for the
do is
$100,000 account.
Everything we do is free to Surge members for the first month. So check us out and see how we use our indicators.
Absolutely. Everybody hear that? Go jump on that ASAP. Let's kind of transition into the CPI. CPI hotness. What do we think? With obviously price index rising 0.4. And then in February, and 6% from a year ago. In line with market expectations. What are we thinking here?
Hey, Boris, you put that on the agenda. So what do you think?
Okay. Well, I've been talking all day long. I didn't want to jump in. I think the CPI is actually fine. As a matter of fact, oil at 66 is going to make a huge difference in CPI. CPI primarily is being driven by what's called owner's equivalent rent, which is a nonsense figure. It's all figures. You can make the argument all government figures in some ways are nonsense because they have to massage a whole bunch of data and average it out and smooth it out. So there's an incredible lagging. It's like a moving average. It's a very, very lagging indicator of what happened 6 months ago. If you look at the most recent prints of where the rents are, they're really coming down hard. And I think the inflationary pressures from that are far more muted than they be. The real issue is, are wages pressures going to really push the CPI higher, and that's not happening. Wages are rising, but at a very modest pace. I think the whole idea, unfortunately, I guess at this point for most labor force, the power of the worker has kind of disappeared for a while. Like it used to be people like, I'm not even coming into work, I'm working remote, I'm doing nothing. Now everybody's like, okay, I got to toe the line because jobs are not as plentiful, or at least employers are not as reluctant. And I think that's the whole point. You're not going to see the kind of wage pressures, which is really the key driver of bad inflation. Hopefully the Fed is smart enough to realize that. I think they are. They like to talk tough just to basically maintain their posture. I'm pretty confident it's going to go at 25. What do you think, Kay?
Well, I mean, that's all that really matters, right? I mean, I think everyone is, if you look at oil, 66 oil, I think it's clear that inflation is coming down. It's less of a concern for many central banks. I think that it's no longer going to be the headline story. But, for us as traders, the reason why this matters is what it means for the Fed next week. Is it going to be a reason for them to do 25 instead of 50 or 0 instead of 25? And I think that they're going to be less, the ECB is still paranoid about inflation. And that's because, their inflation seems to be stickier. But I think with the Fed, because the banking crisis is on the U.S. shores of borders, and because oil prices have fallen so quickly, so aggressively, and because they're worried about the impact of all of this, as well as stock market weakness on consumer spending, I think inflation is going to give them an excuse to do less, not more. And the recent trend of inflation is going to give them an excuse to do less, not more next week. And I think 25 is coming too. I think 0 would really be too much of a shock to the markets. I don't think that Powell's ready for that. And 50, while the ECB, that's what they opted for. The ECB started their tightening cycle later than the Fed, and they've raised interest rates less aggressively. I think, 25 is all the Fed can do in this market environment. And that's why gold is soaring. That is why, Bitcoin's recovering, because, at least the fear and panic about, rates going up to 6-7% have completely evaporated.
Okay. Now, do we think gold gets past 2,000 or no?
Yeah, gold will go to 2,000 if we have any further structural, problem. Like if we have some headline news out of the banking sector, yes. Will it stay 2,000? It's a completely different story. Gold has been, gold is always like a flight to safety mechanism.
Right.
But then as soon as things normalize, people go away. It's a very small market, and it's not designed to handle really serious investor flows. But in times of stress, it's always a fun trade. It's always a fun trade.
Also, 2000 is a big round number, and gold loves to magnify towards the big round numbers. So I think, it's a test of 2000 would be simple. It's not too far from here, and we've got, a bit of time till FOMC, but, that's not really what matters. And what matters is whether it stays there and it goes above there. A test is just, flows magnifying towards a certain level.
Right. Magnetizing,
yes.
And magnifying, amplifying, and magnetizing.
Yes.
It is an interesting thing. I do think that, Fed, if they're kind of dovish next week, that could be another variable to push gold higher, because gold trades on what's known as real interest rates, which is the rate of return less inflation. And if real interest rates are compressing, that's positive gold, because gold has no carry. And I think that could be a situation there. We'll have to see.
Okay. Yeah. I mean, kind of piggybacking off of that, what do we, outside of gold, what do we see happening coming into, like you said, Fed, that kind of stuff, following into the next week? What's happening in our market?
Yeah.
We have a lot more than Fed next week. Fed is one thing on the calendar, but we also have the Swiss National Bank meeting. We have the Bank of England meeting. The Swiss National Bank meeting is really interesting because at one point the market was looking at 75 versus 100 basis points of tightening, which is a big move for the Swiss National Bank. Now, they only meet quarterly, so when they meet and if they need to do something, they obviously need to take a bigger move. But with the whole Credit Suisse situation, everyone will be watching that meeting very closely to see if they dial back, because the ECB has not dialed back. And the SAB with Credit Suisse, they may be forced to do 50 versus 75. So we've got a lot of rate decisions on the calendar. Aside from the rate decisions, we also have what I love, which being the geek that I am, is the PMI reports from the UK, from the Eurozone. They're kind of like the ISM reports in the US, where they give us the most up-to-date, most current look at how the economy is. Everything else is usually for the past month. It's backwards looking. The ISM PMIs are all for the current month. So it'll give us a good sense of whether the Eurozone economy and the UK economy is slowing into the banking crisis. So, I'm going to be watching those numbers. They're going to be very market moving for Euro, if you're trading the Euro. But they do come at the end of the week after FOMC. So it's the Fed, it's the other rate decisions in Europe, and all the PMIs that, we're going to be watching very closely.
Okay.
Yeah.
So we have here.
But overall, I think the market itself, assuming we don't have any more further negative headlines, is probably going to be in a little bit of a churn mode until the chair has the press conference, because they're definitely going to be looking for some guidance. They want reassurance that there won't be any more hardcore tightening for a little while. I think in order for risk assets to take a breather, Right.
So, on Fridays, we like to talk trading strategies, right, Boris?
Yes.
And we like to get into a little bit of trading strategies and, any type of questions that the audience may have. When we had this conversation last week, we were just coming off of, or we're just getting the beginnings of SVB, and we're talking about how that you really need to be nimble. You need to be in and out quickly. It's going to be chop city, and that was one of the tactics that we really recommended to the viewers. And this week we had the big ECB rate decision, and trading news is something that you either embrace or you avoid. And, Boris and I, particularly I, love to trade news. And we're going to have a lot of that next week. So I want to talk a little bit about, news trading tactics. with the ECB, I'm going to show my euro dollar chart here. Hold on one second. Let me just share my screen. Give me a second to do this.
How come your green looks so much greener than my green?
Is this my chart? This is not my chart. This is my chart. Okay.
It's your chart.
Great.
You're on gold.
Okay, but this is not what I want to share because this is my 1 hour chart. I am going to flip this to my 15-minute chart, and let's get rid of zip because it's not necessary for you to see indicators. Okay, so ECB rate decision, obviously this mess over here, okay? And so ECB came out at 9:15, so let's just mark that for ourselves so we see this. And the reason why I'm showing you this is because we have FOMC this week. So if you want to learn how to trade FOMC, well, you've got to understand how ECB worked. So this was the ECB rate decision. I'm just going to type in ECB there. So we live traded it with our BK traders, and we did one of two things. First of all, we traded. There was a two-pronged decision. We talked about this on Monday. How there was a 9:15 rate announcement, and then there was a 9:45 press conference. So what we did is we basically traded the 9:15 rate announcement. And actually, let me drill down to my 5-minute chart. That's probably a little bit better. Show you what I want to show you. Just give me 1 second. We're almost there. There we go. ECB. So as you know, the ECB raised interest rates 50 basis points. And even before the ECB made the announcement, I said that we were going to sell euros on 50 basis points because it would be a fade move. But what I want to point out here is that one of the key techniques that we used, we didn't just go into the market immediately. When you trade news, it's very, very important to make sure that the price action reinforces how you feel or what you think. And what we look for in that case is we wait for the 5-minute candle to close. So it's going to be the most excruciating, the longest 5 minutes, or what feels like the longest 5 minutes of your life. So we waited for the 5-minute candle to close. And after the 5-minute candle closed, the fact that it did not close, the euro dollar did not close at its highs and closed, pretty much right where it started, was confirmation to me. The market did not feel that the 50 basis points was good enough. So we dived into the market, we waited 5 minutes, we sold euros, and boom, it basically went down about 50 pips in a matter of 5 minutes. So that's how one of the tactics that you can use to trade news. Instead of just jumping into the market and jumping the gun, take a breath, wait that 5 minutes, wait for the price action to confirm to you that, the way you feel before you get in. So in this case, if euro, that 5-minute candle had closed at the top of the candle, which means that the market was very bullish and it felt that it was bullish and sustained its bullishness, then the trade is probably to buy, not to sell. If it closed at the bottom, the trade was to sell, not to buy. Now, the indecision candle right in between was a little harder, but I had a very strong view that the guidance, that the market was going to think the guidance was be dovish, so we dove right into the short trade. So as we look to FOMC next week, it's the same situation. We've got the 2 o'clock rate decision. We've got the 2:30 press conference, Eastern New York time. So at 2 o'clock, when the first announcement is made, the market's still divided on 0 or 25 or 50. So what you want to do is same thing, assess, don't guess. Wait for the 5-minute candle to close. Then take that as your guide to to the trade that you're going to take. And that's how you turn news into opportunity and turn news into profits, and how you could embrace trading news rather than avoid it like Boris and myself.
Good tips there. Now, how about yourself, Boris? Are you looking for the same thing, 5-minute wait, and then jump in that deal, or are you?
Yes. So I think what I actually have. We have an algo that kind of trades that that type of strategy, and we can set it for 5 minutes, 10 minutes, or 15 minutes as far as the range goes. But more importantly, we can also figure out. I think the interesting part of news is is it fadeable or is it tradable? In other words, does the news have continuation value or does it have reversal value? A lot of that, I think, depends on the surprise factor, right? And one of the things, by the way, you notice in this particular case, so you had some continuation value, but very limited. If you sort of waited for like on a 10-minute basis, it was much more of a reversal factor. And that the reason why is because the news was pretty fadeable. Like there was not much of a surprise in the news. The key thing is if the news is highly surprising, it's going to have some like CPI. And this, by the way, works much better. The kind of strategy I like to trade is what it called hard number strategy, where you have like a CPI number or an employment number that has a big value proposition. If it beats the consensus or misses the consensus by a large margin, it will tend to have more continuation value to it. Another thing that's interesting, though, by the way, is we talked about this earlier. When you have those confluence of factors, so you have big surprise, the market is supposed to be continuing, and instead it does the exact opposite. That, in other words, you get stopped out on your continuation trade. That actually is a super great signal. Don't despair. What that means is that there is another force in the market that is much more powerful than even the news that hit it. And that force is probably going to have much more power behind it. So you want to just flip around and join that reversal. So if you get stopped on one side of the range and it breaks out the other side of the range, you probably want to join the other side of the range and go with it because there's probably more behind it.
Yeah, I mean, I like I said, for my trades today, my quick in and out as well, and in the US 30 on some sells there, around market open was solely because I saw the rally, obviously the day before, and like you and I have spoke about multiple times,
Right.
Dow, tends to kind of find its equilibrium. And I, figured with all that push up there, kind of hitting, like you said, its highs, said, okay, this thing's got to be pulling down here shortly. So, I got in, got out, and like you said, kind of, now I'm flat because who knows what's going to happen.
Yeah, exactly.
So now, I mean, flat over the weekends because you never know. Big
definitely, and I would say into Friday, you really want to be flat by 11, 12 noon because it's going to get very choppy. Especially as I said, expiration is going to I think create some really interesting havoc at the end there. Yeah.
Now, Boris, do you find yourself when you're looking at like kind of middle of the week, Wednesday to Friday? This is kind of what I've kind of picked up on my trading strategy is that it starts to get a little bit slower. Not always. But it starts to chop around, trying to figure out what it's doing. Yeah. Again, back to the equilibrium thing. I always feel like it's never just this massive continuation and just, huge green or red candles printed out. It's kind of finding its base. And here we go for Monday. It's kind of just waiting.
Right. It's action, reaction, then synthesis, right? It's always that way. It's kind of like, so you have to, it's a dance that you got to get used to. Yes.
That's right.
And it's hard because you're sort of like in that mindset, especially when you're in the action mindset. You're like, oh, tomorrow's going to be the same as yesterday. You're always, you get disappointed. And a lot of times, by the way, your strategy can get disappointed because if you think you have 1,000-point move yesterday, that I'm going to make another 1,000. Usually, when you have a great day, the next day after that is not going to be as great, and you have to just to come and keep that. Yeah, exactly.
Anything else you guys would like to share with with the viewers today, as far as may it be strategies or what you're looking at, that sort of thing?
We're getting some nice comments here on the stream. We're happy to share if there's any questions you have on your particular strategies or your mindset or anything else that you'd like to share with us. We're happy, happy to examine it with you guys.
Right. Now we did have one question here from the Discord. How much time did it take you to get profitable? Or how long does it take to get profitable, and how do you lose the bad habits at the start of your journey? That's one of our questions.
That's a question. It's like saying, how much time does it take you to get fit? Every person is different. And you shouldn't use my time. It took me 35 years to get profitable. How's that? No, I'm just, the point is it's everybody's different and everybody's constant. The key thing is to always be improving. You never, it's not like a situation where I'm a profitable trader. I'm going to be forever that way. Kathy and I are constantly questioning ourselves, what we're doing, and improving. Even she has the same strategy that's stayed forever, but even with that, she's constantly trying to make that strategy better. I'm always trying to improve. What I'm trying to do, money management wise, tactical wise, selection wise. I mean, selection is always the key to trading, right? So there's no real good answer to that. What I would say is the way to get profitable is to keep on trading. There's no substitute for experience. The more trades you make, the better your chances of starting to understand how the market kind of works, and the more that gives you more confidence to start doing more things. Maybe I don't know. What do you think?
Well, I mean, I just want to say that, Boris and myself, our job is to help you shortcut that. So you don't have to wait 35 years. Our job is to, Heb and I've been trading since 1999. I don't even know when Boris has been trading since, probably well before that. He's got more gray hairs than I do.
It's like one of those compliments. It's an insult, but yeah, thank you.
But, we've been through a lot of markets. We have a lot of experience. We're still here. We're still trading. We're calling out live trades. And so we have experience to share. And when you listen to people who've been around the block for a while, you can shortcut that whole process. And, you can just, focus on the right behavior, the right tactics to trade well. And that's, what we hope to impart on you. And, things like that we talked about today. The little tip, like waiting 5 minutes before getting into a news trade, rather than jumping in impulsively. I know we grazed over that, but those are the nuggets you want to walk away with to hopefully shortcut the process, being profitable faster than someone who's just doing it with no help, no coach, no mentor.
Okay. That's for sure. That that's absolutely true. That it really, really helps to be in a room with people who are trading with you, and have obviously our mentorship with you, because we've seen a lot of things. Like anything else, if you're talking to somebody who's an expert, you really learn, a lot more about what you want to do. We've all made the same mistakes, so we have the experience to kind of help you avoid them.
Navigate. Absolutely. Guys, we'll wrap it up with this here. Don't want to take too much of your time. What are the views on USD peso in light of the news around the, peso, in the Mexican economy?
I don't have basically,
no opinion.
We don't trade EM.
Okay.
Like you know what you trade. So we don't trade EM. It's probably an interesting. I know a lot of people love to trade the peso because it moves like 1,000 pips.
But the main thing about the peso is that the Mexican economy is very much tied to the U.S. economy, and so if you get a shock to the U.S. economy, usually it's manifested in more selling, more risk aversion, more concern about what it means for a country like Mexico and its economy. So you're already seeing the peso dollar mex at the top of its range and it's trying to press there. So that's a reflection of just investor nervousness. And I think it's going to break to the upside. But that's less an opinion on the Mexican economy than it is just on the global risk appetite.
Right, dollar strength, exactly.
It's
Very
not
good.
a dollar strength. It depends on our risk appetite.
But that's the same thing. I mean, like if dollar mex is going to the highs, that's because people are afraid, risk aversion, right?
Yes, but I'm not necessarily bullish on dollars either.
No, but right now people are basically parking money in safe currency because they're afraid of ripple effects. I'm just trying to explain. So it's a temporary blip, but that's the reason why it's going up there. Yeah.
Right.
Okay.
Very good. Guys, thank you so much for your time as usual. You guys obviously are giving a lot of insight to all of our viewers here today. We appreciate you, taking time Mondays and Fridays. We had our therapy today, and let's get ready for this next week here coming up. I'll see you guys Monday morning.
Yeah, next week even better than this week. We'll see you guys then.
Have a great weekend.
All right, guys. All right, now you as well. All right, see you.